Hello everybody. So today's video is about volatility and why volatility makes money for MicroStrategy. As always, this is not investment advice, but the stock is $3.99 right now and Bitcoin is way up. It broke $100,000 yesterday. What a beautiful day it was yesterday, but the stock is down, and so Twitter is getting crazy. People are saying, what's happening? Saylor's doing it again, is tapping the ATM. Now even CNBC has found a new stock to bash, and they're super excited about that. They're not reporting on the news that Bitcoin is 100,000. They're not celebrating. They're celebrating the fact that MicroStrategy is down. Anyways, that's volatility for you. So today, of course, if I look at the past 24 hours, Bitcoin is up about 3%. MicroStrategy is down about 2%. And I want to focus on volatility. And of course, while some celebrate the bleed, I think there's a lack of understanding in MicroStrategy here. Volatility is a feature of MicroStrategy. It's not a bug. Michael Saylor wants MicroStrategy to be volatile. He says all the time, volatility is vitality. He wants the stock to be volatile. Why? Why does he want the stock to be volatile? Because volatility is valuable. Volatility is valuable because volatile stocks have much higher options prices. Volatile stocks trade at a premium because you can write options on them at a premium. They are more desirable because of their volatility. There is an entire financial ecosystem of people that make money from owning these volatile securities and writing options on them, around them, taking positions, shorting them and longing another asset, or longing them and shorting another asset. Traders, hedge funds, money managers, if they own MicroStrategy, they may own it for reasons related to volatility, such as collecting a premium because the stock is volatile. And collecting that premium they do. And of course, because the stock is volatile, MicroStrategy is able to attract a broader shareholder base than just Bitcoin enthusiasts. More people are drawn to MicroStrategy, just like some people are drawn to, say, the VIX or to SMCI, and they could care less about SMCI. Well, you have people who are drawn to MicroStrategy or the NASDAQ or the Triple Q. They're drawn to that because these assets are volatile, and if they're volatile, you can write those options, you can write those premiums. And there is also a case to be made that if the stock had no volume, no volatility, if the volatility were to drop, which I don't think is going to happen because MicroStrategy, let's not kid ourselves, that's a derivative of Bitcoin. But if volatility were to drop, you could make a case that a lot of people would get out of MicroStrategy and the price to NAV could fall closer to that of an ETF. But MicroStrategy trades at a premium over the Bitcoin on the balance sheet. Why? Because of that volatility that it adds on top. And why is volatility so important? Because the case I'm making in this video is that Michael Saylor has some control on the volatility of the stock beyond the volatility of Bitcoin alone. Yes, there is some added volatility in the price of MicroStrategy from the fact that MicroStrategy has a little bit of leverage. And I covered that in a prior video. The leverage is really not that high. They have about $7 billion of debt for a $100 billion market cap company. The level of debt on MicroStrategy is not that high, but just from that leverage, from that debt, you get a little more volatility on the stock compared to Bitcoin. But the case that I'm making is that Saylor is creating more volatility by strategically using the ATM, strategically tapping the ATM whenever the price to NAV tops, whenever the price to NAV gets quote-unquote frothy or it gets a little high. Michael Saylor doesn't want the stock to just go up without volatility. He wants a lot of volatility, and so he taps the ATM whenever price to NAV peaks. And when he taps the ATM, the stock goes back down. And when the stock goes back down, then you have retail investors and savvy hedge fund managers, why not savvy investors who get back in and bid on the stock again. And then the volatility goes up again. And then he issues the ATM, he taps the ATM again, and it goes down. And Saylor has a clear understanding of the volume on the stock. And as the volume on the stock gets into more perpetual bid from, say, the ETFs, you may know that around the world, really, not just in the US, people buy those ETFs monthly or bi-weekly. So you can see the flows. You can see when the flows are about to come. And so you can decide whether you want to let the new flows into the stock increase the price to NAV of the stock, assuming that you've been in a period where NAV was low, you wanted to do that. But when the price to NAV gets frothy, you can strategically decide when you tap the ATM to take that price to NAV down again. And you also have some leeway in buying Bitcoin. So you can tap the NAV, for example, on a Monday, and you can buy Bitcoin on a Thursday. And then you announce, right? Because it's a material change, so they have to announce. But there's a delay, so there is a leeway on that delay between tapping the ATM and actually buying the Bitcoin. And so an example of that is I think it's probably strategic why the Bitcoin is announced on Monday morning and why he tweets, oh, it needs more DOT on Sunday. Saylor is playing around that volatility. And so Bitcoin has natural volatility. On top of that, Saylor adds more volatility from the leverage, the little bit of leverage, but also from the strategic timing of those ATM issuances. And I think that's what he's doing. And I think that's important. Volatility is crucial in two main ways as well. Two other ways where it's crucial beyond the simple desirability of the equity. It's crucial because whenever he taps the ATM, he wants to make sure there's a lot of volume. If the stock barely changes hand, tapping the ATM can really hurt the stock price because assets trade at the edge. Making sure that there is a lot of volume, that there is a lot of volatility, vitality on the stock, means that whenever he taps the ATM, there's going to be buyers of these shares. And this is going to be less of an issue over time as we get into the QQQ and there's more of a perpetual bid on the stock. And I would argue it's perhaps not an issue as of today, but that's of a lesser point. The bigger point is the convertible bonds, the convertible debts, right? The convertible debt, a lot of people buy this debt, and I estimate it's maybe 75 to 80% of the people who buy these convertible bonds, they buy it because of the embedded call option. The call option that comes out, 4 years out for, say, their 2029 convertible bonds. These convertible bonds have an embedded long-term call option that MicroStrategy is selling via way of a convertible bond. And so when the convertible bonds are oversubscribed, that means that people are valuing that call option. Another way to think about it is that MicroStrategy increases the volatility by doing the ATM and tapping the ATM strategically early, increases the volatility. And when the volatility is high, he then decides to issue a convertible bond. And of course, he wants to issue that convertible bond when the volatility is high, because selling a convertible bond is like selling an option, like a retail investor selling a call option after volatility spikes. If you own a stock, volatile stock, and you're a retail investor, you may be more inclined to sell call options on your underlying stock when there's high volatility. MicroStrategy is more inclined to sell a convertible bond on itself, and that bond includes the right to buy in the future in 2029 for the latest converts. You may be inclined to offer that after the volatility, so you make the stock more volatile, and then you sell your convertible bond at a premium. Another way, and it would be much more profitable to do so than to just do the ATM later at the same time. Another way to think about it is step one, you excite, you oscillate MicroStrategy stock via the ATM, via strategic issuance of the ATM and strategic announcement of when you buy Bitcoin. So you accelerate that oscillation. And you do that early with ATM. And you do that why? You shake the stock. You do that, and you take advantage, and you amplify. The movement of a stock is amplified, for example, by MicroStrategy noobs, I'm going to call it, who say amplify that shake. And so an example of a MicroStrategy noob would be NAV arbitrage, like a TradFi shorts MicroStrategy because they think that the price to NAV is going to go down, or it could be a TradFi who's totally clueless about Bitcoin, who say, "Oh, I'm gonna short MicroStrategy because Bitcoin is bad," right? That's sometimes, often actually, a reason you see for people shorting that stock. So all of that may look bad on the surface, but it just amplifies the volatility around the stock. And the more volatile the stock is, the more MicroStrategy is going to collect, the bigger the premium MicroStrategy is going to get, because the convertible bond is issued after the stock was oscillated. So you convert those buyers who buy the embedded call option, and they pay a big premium. So the convert buyers, that's what I meant here. The convert buyers, convertible bond buyers, they pay a big premium because MicroStrategy stock was oscillated, was excited prior to them buying. And so I think this is quite a genius way to think about it, and this is exactly what has been done. This is the genius of Saylor. This is, Saylor is a chess player. He thinks for the long run. He oscillates it, and then he issues the convertible debt. You don't issue that before, you issue that after. And I'll conclude, and you'll forgive me for the French nature of the analogy, but this is, so Saylor used oil to describe what he does in his presentation. Well, I'm gonna use cream. So forgive me for the analogy. You have this thing, it's called heavy cream, or crème entière in French. It's cream that even the hipsters at Starbucks wouldn't want that cream. It's 40% fat. In fact, I would make a case that prior to the 1600s, that cream was not really considered valuable. Have you ever tried cream like that? It's so fat, maybe it makes you throw up. That's heavy cream. Heavy cream, 40% fat milk in a way is how you can think it. It's essentially fatty. Few folks drink that pure, but of course tastes are different culture to culture. I don't want to say they don't, but few folks drink this pure. You oscillate it. You oscillate it how? Well, you whisk it. You whip it, right? In the US, this is called whipped cream. You whip it, you whip it, you whip it. You put a lot of energy. And you take that heavy cream, which is not very good as is, believe me, and you whip it, you whip it, you whip it, you whip it, you whip it. Right? You do that for, 3 minutes, 5 minutes. And then what happens after you do that? It turns into Chantilly cream. It turns into whipped cream. And whipped cream, what do you know about whipped cream? Well, it's very expensive, isn't it? It's very valuable, right? You go to an ice cream shop, you want a whipped cream supplement, it's going to be $3 extra, or €3, or €2 extra. And you collect that premium. That product, not very valuable, unwhipped, unoscillated, unexcited, you excite it, and then it becomes Chantilly cream, and it becomes the stuff of kings, and it becomes extremely valuable. And dare I say, if you keep whipping it, it might become butter, which is even more valuable. So, to conclude, you want the shaking of the stock, you want the volatility prior to the issuance of the converts. The volatility is the vitality of MicroStrategy. The volatility is what turns MicroStrategy into simple, heavy cream, kind of disgusting, into delicious Chantilly cream. So hopefully this was not investment advice, not financial advice. Not hopefully, this was definitely not food advice. Just entertainment. Hoping you were entertained. Please like, please subscribe. Thanks for watching. Follow me on Patreon. Have a wonderful day.